You are listening to Keystone's Stock Talk Show, episode 314. Great to chat with you again this week. I kick off the festivities with an update, answering a viewer question on Athabasca Oil Corporation, ATH, on the TSX, a Canadian energy company focused on exploration, development, and production of thermal oil and light oil assets in the Western Canadian Sedimentary Basin primarily. The company holds a solid balance sheet, a strong share buyback plan, and potential growth. But is there value in a lower oil or energy environment? I will let you know. Brennan revisits and answers a viewer question on Verde Agritech Limited, symbol NPK on the TSX, an agricultural company which produces and sells fertilizers in Brazil and internationally. The stock is recently, over the past month, up 270%. From afar, it seems to be driven more by hype than substance, but Brennan will dig into what is driving the stock. Brett has our dog of the week, Colabora Group Inc., symbol GCL on the TSX, a wholesale food distributor based out of Quebec. Last week, following poor earnings announcement and a management dismissal, the stock has plummeted from 63 cents to a low of 14 intraday and subsequently recovered to around 28 cents by the end of the trading day. Brett will let you know if this company holds any value after the declines. All right, let's get to the show. I welcome my co-hosts, the Killer Bees, Brett and Brennan. How are you guys doing?
Doing well.
Good.
Doing well.
Back from a Friendsgiving.
Yes, I was. Another one. Too many
and
friends.
Another wedding.
And a wedding.
How many times are you gonna get married, buddy? Tomorrow.
Oh, and next year, like, it's funny. Like, even at the Friendsgiving, I was handed another wedding invitation to a wedding next summer. So next summer is gonna be, another one of those, 4 or 5 wedding summers.
Yeah.
Yes, so it's going to be a lot.
You got to quit being likable, okay? That's the problem.
Apparently. Yes, apparently.
It's gross. Just have everybody hate you and then you never get invited.
Yeah, that sounds like a plan.
It's amazing. Well, just a little inside baseball here. I've got to grab a flight in about 3 hours when we're recording this. So we're going to go along quickly today. I am going to, Brett is coming tomorrow. I'm coming in a little early to Toronto to get the baseball game. I'm kidding. I'll be on the flight when the game is on. There's a game 7 tonight, so we don't know what has happened. Hopefully the Blue Jays win that. It's game 7 there, but we're coming in for the Planet Microcap show in Toronto. It's in partnership with the Microcap Club. Should be a good list of companies, 10 to 12 companies that we'll sit down with at that event. We probably would have interviewed about 18 to 25, but we actually have interviewed about 8 of the companies there just in the last 20 days. So we kind of pared it down to 10 to 12. All right. Well, we might as well get into the show. We have a poll, and Brett's going to handle that.
Yeah, so we got a nice and easy poll. With markets hitting all-time highs, have you changed your cash allocation over the past year? 57% of our viewers have said they have increased their cash share in the portfolio. 37% said roughly the same, and 6% have actually decreased their share of cash in their portfolio. So we're really seeing people, at least our viewers, pull back on their riskier assets and hold some more cash, which I that's what I've done myself. I've been taking profit in some of my high flyers, taking some risk off the table more than anything, and I'll reallocate once I see some more opportunities.
Yeah, I don't think we've fundamentally changed the way we look at the markets and said, okay, we need to own more cash now. It's just been we've had some tremendous gains in some companies that we own, and there's been some profit taking that we've taken, and that increases the cash value near term. On the flip side, it's more difficult right now to find real growth that's sustainable at a reasonable price. So there's cash just sitting there. It will be deployed likely over the next 6 to 12 months. At some point, there's a pullback in the market. We're sitting there, 10, 20 names potentially we'd like to buy. We'll get some opportunities at some point, or maybe we won't. And the companies that we continue to own will continue to run higher, which would be nice as well. But it would be nice to see some pullbacks, buy some good companies over the course of this year. Brennan, so I answered there's more cash.
That's I mean, I'm sure that people are sick and tired of hearing this, but, I've been going to more, at least bonds right now. I've been trying to, slowly move more to cash.
The world is sick and tired of it, Brennan.
purchase a house here eventually. Now I have a girlfriend on my ass that really wants me to slowly do that and move over to cash. So, in the spring or even the winter, we're ready to buy a house together. But we'll see. We'll see how that goes
Brennan's
out.
investment strategy driven by his girlfriend. We just figured that out right now.
No, I wouldn't say investment strategy driven by girlfriend, but timing, of course. That's a big factor. I know Brett did a segment, years ago, just on, how much cash should you hold in your portfolio? Well, it really comes down to personal circumstances in a lot of cases.
For sure. All right. Well, like we said, got that flight to catch. So let's move the show along. I am going to share my screen now. Okay. I'm going to start with a viewer question, your stock, our take segment on Athabasca Oil Company. Symbol is ATH on the TSX, $6.31, $3.15 billion market cap. Doesn't pay a dividend, but they are returning capital to investors via share buybacks. They are a Canadian energy company focused on the exploration, development, and production of thermal oil and light oil assets in the Western Canadian Sedimentary Basin, that Alberta, Canada, essentially. Founded in 2006 as a private company, they followed an aggressive land acquisition and joint venture strategy during the oil sands boom days that tracked an increase in global oil prices. Athabasca then completed its IPO in April of 2010. Issued 75 million shares, $18 for gross proceeds of $1.4 billion. So you can see the share price is significantly lower, about a third of where it actually IPO'd. The business is typically organized into two main operating segments. Thermal oil, this segment focuses on exploration, development, and production of bitumen from oil sands, primarily using in situ methods like steam-assisted gravity drainage, or SAGD, in the Athabasca region of northern Alberta. This segment is the primary source of revenue. There's light oil through a 70% stake in its private pure play Duvernay subsidiary, Duvernay Energy Corp. This segment involves the production of light and medium crude oil and liquids-rich natural gas from unconventional reserves, particularly in areas like Greater Kaybob area, including the Duvernay Shale play. Athabasca Oil provides 100% payout of its thermal oil free cash flow to shareholders by distributing it to all share. It's essentially driven into share buybacks, a strategy outlined in its 2025 budget and financial reports. By using buybacks instead of dividends, the company aims to increase cash flow per share for its investors. So let's see how is the share price done over the past year. Done fairly well in a weaker oil environment, up 23, just under 24%. But this is all time since it IPO'd. Not the greatest performance, down 60% there since the company IPO'd. Right now, let's look at some business highlights. Here's a corporate snapshot. Producing approximately 40,000 BOE, barrels of oil per day, which is about 98% liquids. And the company boasts long life assets with low base decline. Core cash producing assets is used in share buybacks. Those are the thermal oil assets. These are predictable, low decline projects, efficient brownfield SAGD development in place as well, and it has a strong reserve life. The plan is, again, like I said, to deliver 100% of the free cash flow and return that to shareholders. They estimate that there's about $1.8 billion of free cash flow to be had between 2025 and 2029. That would be at about $70 WTI. Has already completed $650 million in cumulative share buybacks since April 2023. There is a good tax-free horizon here, $2.2 billion of tax pools. Growth will come from a number of areas, but there is the Leismer 40,000 barrel a day progressive expansion over time that's projected to cost around $300 million. The approvals, the regulatory approvals to do 40,000 barrels a day have been received here. There's further upside through their joint venture. This is a private company, the Duvernay Energy Corp. It's a pure play subsidiary, self-funded and flexible development, de-risked resource and high margins here. Again, it is a private company. It is Athabasca operated, 70% owned, and Cenovus owns the 30%. They have an equity ownership at 30% in that as well. Right now, production is around 4,000 barrels of BOE per day. And the exit rate for this year is predicted to be between 5,500 and 6,000 BOE per day. It's self-funded. The growth potential here is to get up to around 20,000 BOE per day, about 75% liquids that would be by late in this decade. So significant growth potential if that is achieved. Let's look at the recent results. The highlights here: average production, about 39,000 BOE, 98% liquids. That is 4% growth, which is solid. 15% per share growth, largely because of the share buybacks. This is something, in terms of production, it's something management can control in an energy company. So it's good to see some growth there. Cash flow, adjusted funds flow, 25 cents per share. As we can see here on a per share basis, it's actually down 17% to 20 cents from 24, driven by lower energy prices. That's something the management really can't control. Let's look at those share buybacks. Purchased 24 million shares through its buyback program year to date. Athabasca is committed to returning, again, 100% of its free cash flow from its thermal oil, and has done significant buybacks since 2023 already, reducing its fully diluted share count by 21%. Strong financial position. There is net cash of 119 million. Let us look at the company's outlook. Their production outlook: they anticipate production at the upper end this year of guidance of 37,500 to 39,500 barrels of oil per day, with an exit rate of 41,000 BOE per day. Thermal oil production is trending at the upper end of prior guidance. The Duvernay energy is expected to average around 4,000 BOE per day, with an exit target of 6,000 BOE per day, following the tie-in of 2 multi-well pads. The focus here is on free cash flow, to generate that through the thermal oil assets, as we can say, and to buy back shares. And there is some growth also in that side of the business, and then to grow with the Duvernay assets. Let's look at the valuations. Based on 2025 expected numbers, Athabasca's debt-adjusted cash flow multiple is around 5.4. Their peers are around 6.3. So it's a discount, but not a severe discount to peers. Some of the boxes that we look at in a conclusion here, generally to check off with an energy company, we'll see if Athabasca checks those off. Does it have a strong balance sheet? It is net cash, so we check that off. Production growth here over the long term, we check that. Relatively long reserve life, yes, that checks off. Low cost production, it's a check here. Low to reasonable valuations. Well, given the weakness in energy in the near term, we'd say it's just kind of trading near fair value. Good management team, that would be under review still. Overall, Athabasca combines long life, low decline thermal oil assets with high growth potential from its light oil reserves, or moderate to high growth, I would say. Intriguing in the near term, but faces weaker near term environment. Intriguing in the long term, I would say, but it faces that near term weaker environment. So it's a company we certainly monitor, and we do like the balance sheet and those share buybacks. All right, guys, did you have any comments on that?
Yeah, I just think the only thing that I would say is I like your conclusion where, you're showing, where it's checking off the boxes. Because even as you were going through the segment itself, I was thinking, I'm checking off the boxes in my head: net cash, production growth. These are the things that obviously we're looking for. But yeah, it doesn't look bad.
Yeah, it's certainly interesting. I mean, we have some a name or two that trade at lower valuations, have great balance sheets as well, but not necessarily the long reserve life that Athabasca has. So, I mean, there is some, there's definitely some interesting, we would have some interest in this company. We continue to look at it. So for the viewer that sent that in, yeah, it's a company that piques our interest, and we have been looking at and will continue to look at. If it pulled back in a weaker oil environment, given the long-term life of the assets, it may be a company that we'd look at.
Yeah, especially on just like you were saying, the lower price that's going to start to, we're in the range where you're going to start to see companies that are hitting their break even points in the
Yeah.
U.S. and Canadian fields. So do we start to see actual production decline if we do see a persistent, especially sub $50 WTI? Do we start to see production actually substantially decline? Because for Athabasca, they're noting a $55 WTI for their capital
Yeah.
break even. So that right now they're effectively at break even for capital for the growth profile and the shareholder returns, which is good to see. It's not some players that are significantly higher, especially if they have debt on their balance sheet. It can really hurt very quick if you start to see these below 50, especially if you hit the 40s. They can get hit hard very quick, and they can actually just go right out of business if they aren't in a debt position, which Athabasca is in, which is, like Brendan was saying, checks a lot of boxes.
Yeah. And that's why we stress very strong balance sheets in these businesses, commodity related businesses generally. Even if you have great long life assets, if in the short term the price turns against you and you're producing negative cash flow, you have debt. We've seen companies with good assets have to continually dilute to just get back to the times when they can make money, and not just, it's not something you want to see as a shareholder, and it doesn't achieve long-term returns. Again, we got to look back further on Athabasca. There has been negative returns since this company has IPO'd. It was a different time then. There was a ton of optimism about the oil sands, and now we're looking at these assets differently. But there is free cash flow coming, and if we're not converting completely to electricity in the next 5 minutes, there's probably some value in this business over the mid to longer term.
Question for you before we move on. Just looking at this space and how we've seen investors chase yield a lot of the time. Do you like the strategy of the share buybacks being more nimble than potentially having a dividend? I mean,
Yeah, I mean, I think no, it's not. I think that we always say that a dividend in an energy or a commodity related business is a bonus, even if there's a low payout ratio. It's such a fluctuative market, variable market. In this case, they don't have to keep funding that dividend. They could just buy back less shares. So potentially, people know that they're trying to grow free cash flow over time. It may be a better way to structure that business. I think some of those companies get in trouble. They have to cut their dividend. They bring it back, cut. It would be less noticeable to the average investor. I think the average investor should always look at these companies and as a dividend, as a bonus. They don't. They buy it for the yield, then they may sell it off if there's a cut. In this case, it may be a more effective way of holding, of communicating to investors. You don't have to keep that dividend, and it communicates poorly to investors when that dividend is cut or reduced over time. So in this case, I mean, the goal in any business is to increase your per share cash flow over time. This can help with that. So it may be a more effective way, smarter way of positioning themselves. So dividends and share buybacks, they're all shareholder friendly. In these cases, like, they're going to be very variable in this business. Like, the cash flow this year versus last year has shrunk. So the buybacks this year versus last year have shrunk. If you have a dividend that fluctuates like that, the market doesn't typically reward you for that. So, I think maybe they're saying the market doesn't care if we have a dividend. Let's just buy back shares effectively over time and then increase per share cash flow. So yeah, it could work.
Yep. Awesome.
We will see in 10 years. But it's interesting for sure. All right, let's move on so I can get a flight.
Yep. Another commodity
Brennan,
business. Let's
you've got Verg Agritech. Now, this is a company that we have interviewed in the past a couple of times. There's been a bump up in the share price of late. It's been very volatile. This company, lack of profitability over the long term, and a lack of company hitting their guidance.
Yep.
And I'm just going to be frank with this. We've interviewed management, and it didn't screen well in terms of just the plan for the business.
Okay, so Verd Agritech, NPK on the TSX, currently trading at a price of about $1.72 and about a $90 million market cap. So they are an agricultural company which produces and sells fertilizer in Brazil and internationally. Now, we've covered Verde a few times on the podcast. The first was as a dog back in April of 2023, following a decline of over 50% in 3 trading days after management cut guidance. The second time was in September of 2023 as a Your Stock Our Take when it traded in the $2 range. And the last time was in the spring of 2024 when it traded at about 90 cents. But each time the business didn't screen very well, and we believed that it was more speculative in nature. However, the stock is recently up over 270% in 1 month. So let's dig into the business here, see how the fundamentals are looking today, and see what is driving the stock higher. Now, just going over the business a bit here so you can understand it. Verde's potash reserve is 5.9 billion tons of potash as approved by the Brazilian Mining Agency. They are currently permitted to mine 2.8 million tons per year, and they have manufacturing capacity through its Plant 1 and Plant 2 for a combined 3 million tons per year. Verde is also looking to expand this further with a new mine pit pending permit approval, as well as an additional plant, number 3, which could provide additional production capacity of up to 10 million tons per year. Looking at their Q2 2025 results, the company's tons sold were down to 80,000 with total revenue of just 4.8 million, which is down 26% year over year. EBITDA was a loss of 182,000 compared to essentially break even in Q2 of 2024. And net profit was also a loss of 2.4 million, which was slightly better than last year. And looking at tons sold, it continues to be depressed in the levels or from levels in 2022, with the price of potassium chloride also remaining depressed from the elevated levels in fiscal year 2022 and fiscal year 2023, sitting at about USD $352 per metric ton. So it is up a bit year over year at this point, but at this level, with its current tonnage being sold each quarter, I believe they will continue to produce losses throughout this year and into next unless something drastic changes. The balance sheet also remains in a net debt position of 43.1 million with negative trailing 12-month EBITDA. So the balance sheet doesn't look great, in my opinion. And the valuations also at this point right now remain extremely elevated given the lack of earnings and cash flow, with a trailing price to cash flow multiple of over 130 times. Now, the company didn't provide fiscal year 2025 guidance, or at least I couldn't find any in their MD&A and press releases. But looking at their fiscal year 2024 and fiscal year 2023 guidance, they missed it substantially. As you can see here in 2023, they were looking to sell 800,000 to 1.2 million tons, but only sold about 428,000 tons. And then in 2024, they guided towards 700,000 to 800,000 tons, but only sold 319,000 tons. So it doesn't surprise me that management isn't providing guidance, given they missed it by such a wide margin over the last few years. It's also worth noting that after the boom in fertilizer prices experienced in 2022 to 2023, many farmers in Brazil experienced significant difficulties from elevated fertilizer prices, reduced grain prices, elevated interest rates, and now tariffs. In fact, a survey conducted by RGF and Associates indicated that in Q2 of 2025, 388 agribusiness firms were under court-supervised restructuring in Brazil, which represents a 60% increase from the same period last year. And of every 1,000 agribusiness firms operating in Brazil, 11.5 are in bankruptcy protection. This is the highest rate of any industry in the country. And to put it into perspective, the manufacturing industry is at about 6 per every 1,000. However, despite the grim potash market, what's driving the stock recently is the company's recently announced Man of War ionic absorption clay rare earths project, which currently has a scoping study underway with a timeline to complete initial drilling and provide assay results in Q4 of 2025, and to potentially release a preliminary economic assessment in mid 2026. So this has been driving the stock up on this, kind of enthusiasm recently. But to conclude here, Verd has really been, a struggling business. They've been struggling financially and, recently unable to produce positive EBITDA. Guidance was missed in both 2023 and 2024, and they didn't provide guidance in 2025. The agriculture market is currently depressed in Brazil, so the outlook for potash sales in the country may continue to look grim over the next 1 to 2 years. The balance sheet remains levered and negative, and has a negative 12 trailing month EBITDA. Plus, they're now spending money to prove up its rare earth project, which is not a great look in my opinion. The stock has performed well as of recent due to excitement around its new rare earths discovery project. But in my opinion, I believe it is highly opportunistic by management to be looking toward developing rare earths, as their main potash business looks very grim, almost as if management is trying to go after a bit of the flavor of the day in the market. So right now, I would say it's highly speculative. We continue to monitor the business. Maybe they're able to prove a substantial mineral resource and preliminary economic assessment for rare earths. But again, it's just highly, highly speculative. And given management's track record of execution, I would be very cautious with this company at this time. And there is the disclosure.
I think you hit it on the end, the track record of over-promising and under-delivering. And it wasn't just misses. Those were massive misses in terms of production. And production is something you can more control than revenues in a business like that. And they weren't close. Yeah. So, you get it. We do check marks. You get an X from us when you significantly miss estimates in terms of production. And now they seem to be moving from this, the business that has, and the ag side that has failed, to rare earths, which are, a flavor or topic du jour. And to us, it looks like, if I had some advice for the company, raise money right now. That's what you should do. Your share price is relative to the underlying fundamentals of the business right now looks overvalued. If you can get people to give you capital, do it right now. I wouldn't be giving capital at this stage, because there's companies we can find that have that upside with far lower prices. There's a company, small cap, in that segment that is actually making money that we're looking closely at right now, and has a far better balance sheet. That's net cash position. That's what we prefer to invest in versus something that is now flipping to another business potentially. Keeping that core business, but it's core losing money, and then if you had a core business that was making money and then we're, okay, well, let's capitalize on this discovery, fine. Core business has not been managed well, has not hit targets. That's what we can say. And now they're into another business, and, there's a huge, long process to go from that small, the discovery to where you could actually have cash flow. And there's a lot of pitfalls on the way to that. And they haven't managed the existing business well in terms of getting it to actual sustainable cash flow. So
yeah. If like the potash business, like you already said, if the potash business was, cash flowing and they were able to, fund this exploration through cash flow, it would be, it's kind of like an optionality. It's interesting, or more interesting to me. But this just screams high risk. And I wouldn't touch it with a 10-foot pole.
Yeah, and even further than just
tell us what you think, Brennan.
Company's execution. So just to even further lay on the risk, you have to just take into consideration really U.S.-China relationships. Even though it is a Brazilian company, what's been driving all this rare earth from mines to the production of magnets? It's the U.S.-China relationship. China cutting off the U.S. to the. At this time, they're cutting them off. Sometimes, some days they aren't. Some days it seems like they are. And it's that volatility. And then the multiple years it would take to actually get production up running. Things will likely change for better or worse in whatever your prerogative is. But things are going to change. And that's that risk layered on top. Even if management were to somehow execute perfectly, Ryan and Brennan already went over why there's a decent chance they won't. But even if they do perfectly, it could still go against you just because of the nature of the environment. And we're seeing more and more of these really hype stories around rare earth metals. And if you do have massive production come online, because right now there's no US led production. It's all Chinese, especially on the processing side. Do we start to see a glut in 5-10 years? That'll be my next question. Do we actually see overproduction? Because you do see these duplicated scenarios. You have full mine to magnets in China. Do we start to see that in the US, Europe? And do we get an overall global glut? That can also, just gonna throw that out there as well. I don't know if you guys have any more thoughts.
And many of these rare earths aren't as actually hard to find as, say, gold is today or anything like that. So you could get into oversupply. And when we see hyped markets, I mean, it is different, but for example, cannabis in Canada, massively oversupplied, a ton of capital floated in, a ton of capital may float into this. And then you get your, oh, yes, we had a great mine and we even brought it to production, but now there's no oversupply. Oh, that's hit. It's commodity-based business is very, very difficult. Not saying you can't make money investing in them, but very difficult. And in this case, all we can judge this company on, this management team, is their past track record, and they're continually missing their own estimates. Those are their own estimates, not estimates from the market, estimates from analysts. These are their own estimates, and that's all we can judge them on. And if they hit them, we'd be very happy. They're not hitting them. So, that's what we can judge them on, not executing on their own targets. All right. In the interest of my flight, let's get to the next company. I think it's dog of the week, and that's Colabar. Brett's gonna look at that.
I'm just gonna try to drag this out. Make sure you miss your flight.
I've got time. Don't worry.
You got time. He's got time for me today.
Sure.
So
yeah.
But no. So Colabar, symbol GCL on the TSX, is a wholesale food distributor based in Quebec. Colabar serves hotel, restaurants, and institutional markets, as well as retail markets across Quebec and Atlantic Canada. So the stock has really just plummeted after announcing their Q3 earnings, falling from 63 cents at the prior day's close to a low of, I had 14 cents here, but I checked my broker, it was actually 12.5 cents after the open there. And it subsequently recovered throughout the day to about 28 cents by the end of the trading day. And as well, just at the time of recording, it's at 30 cents. This is going to be a bit more volatile, so I'll highlight that. So you're watching this week from now, the price might be a bit different. And at the current price, it's about a $30 million market cap. Further, if we step back, it wasn't just this one day decline, even though that was a massive decline. It hasn't been performing well over the past year. The stock's declined 73% from $1.10 a year ago. Clearly poor stock performance even prior to the recent drop in the past year. So let's look into why. First, a bit of a higher level view, and looking back prior to the last quarter results, which we'll get into in a minute. The company has had a slightly positive EBITDA with net income, lost many quarters up, down, fluctuating around that break even for net income, with the interest being the major differential between the EBITDA and the net income. So normally most quarters were positive EBITDA or adjusted EBITDA, but then net income up, down, right around the break even. The company has continuously taken on more debt over the past year, notably though with the acquisition of Alum Plus, and that has just massively increased their net debt position to $97 million in Q2. So this is not even the most recent quarter, over double the prior year, resulting in a net debt to adjusted EBITDA of 4.3 times up from the previous year, 2.4 times. So debt concerns come into play in the prior quarter, just due to the ramp up of debt due to the acquisition of Alum Plus. Now, let's move on to the last quarter. Why was it just so much worse when even Q2 was already looking quite a bit of leverage? The results were poor enough actually for the CEO to resign effectively immediately, which can add to stock market panic. Of course, you see management effectively running away. That is a concern. This is not long after even the former CEO resigning in June, with Kelly Shipway being appointed as CEO at the time, but now has actually shifted into the CEO position at a very rapid pace, to say the least. As well, I will note a board member, Warren White, passed away unexpectedly as well in October. So you do just have big management shifts across really the board, pun not intended. And let's really look now into the last quarter, Q3. The company did see its first full quarter of contribution from Alum Plus, and that's the driving force between that. You can see that big revenue growth of it added $53.3 million. That's a 31% growth rate over the past year to that $212 million. The company was impacted, however, negatively actually by a cybersecurity incident which lowered revenue by an estimated 8 million, creating some drag there. So even on top of the growth, you did actually have some drag there. But net income was massively negative at 74.4 million, as the company had a 75 million goodwill impairment, as accounting estimates declined materially, citing unfavorable economic factors in certain industry sectors, resulting in a decrease in volume of sales, profit margins, and the growth prospects. So effectively the exact opposite of what someone owning the stock would want to hear, which is why you just have that massive goodwill impairment. It is just an accounting figure, but it does really just highlight the state of the business prospects going forward, even from the accounting point of view. But the big downfall that I'll highlight is the drop in adjusted EBITDA, dropping 39%. So you had that revenue growth, but EBITDA actually dropped 39% to only 5.4 million with a very slim 2.7% EBITDA margin. The company was expecting cost savings with the Limplus acquisition, and now they're looking at an accelerated transition from the Limplus facilities, and they do expect cost savings in Q1, so 2 quarters from this one, of 12 million run rate, but that won't be fully seen until Q1. And for now, debt is just being the stressing factor. It is very high debt level at net debt to adjusted EBITDA of 7.8 times at 112 million in net debt. The company has also seen a liquidity crunch on top of the debt level. That's where you run into these issues. You run into liquidity and solvency issues at the same time. That can easily just take out a business effectively overnight, or wipe out equity, or cause mass dilution. On top of the acquisition, which obviously did put a higher debt level, working capital outflow was higher than expected at 14.2 million during the last quarter. So you have cash outflow from the acquisition as well as higher working capital costs. That just puts a massive crunch on liquidity. And when someone's already starting to see, or a company is already starting to see high leverage, that just creates massive concerns. And due to this, the company actually needs to raise a minimum of 15 million in equity at this time to meet its forbearance agreement, effectively debt agreement, to push out the impact from debt restructuring. Given the high risk and recent share price collapse, the raise will likely even be at a more punitive price than the 30 cents. You're looking at least 50% dilution at a 30-cent price, which I'd say likely they're going to raise 20, maybe 25 cents at best. So likely higher than 50% dilution. And that's the reality, is you're going to have a further discount, because why would someone want to take on 50% of your equity if the business could very reasonably go out of business in the next year? And that's further issues, delays, could easily wipe out any existing equity, effectively being the crux of the decline. Can the company even survive in the near term? For the hopes of any potential of realizing any of the synergies of the acquisition, any of the planned growth of the acquisition by consolidating the two entities. So for any share price upside to occur, the company just needs to survive without massive equity dilution, which are massive hurdles. But for now, Culliver is our dog of the week, and just for disclosure, we do not have a position in the company.
It's a lot of debt.
Yeah, a lot of debt.
Yeah, and just like a track record of continuing to, there's not a ton of growth. You look back in December, I mean, it was a different business, but you look back December 2025, about 1.4 billion, and in revenue is now down to 665 million. I guess that has grown from where they were in 2020 at 461. But, you want a company that has a long-term track record of growing and growing profitability. And we don't have that with this company and growing its EPS. And it's not surprising to us. Lower margin type business, not surprising to see continued weaker quarters with the debt levels that you see in this business. It's one that we've looked at multiple times and just taken a pass. Not the worst business out there, but we continue to monitor it. It's not a company we're investing in right now. Brennan, you got nothing?
I got nothing.
That's good. All right. I get to get on a flight. So, okay. If you are if you're watching this on YouTube right now, smash that subscribe button. If you are listening to this wherever you consume your podcasts, rate and review us. Keep your questions coming into our Your Stock, Our Take segment, and we'll endeavor to answer your questions on a weekly basis. And as always, I wish you profitable investing. Thank you.
Thanks, everyone.
Thank you.